Today we're going to explore how to invest in dividend stocks. While this video is for beginners, it's really for intermediate and advanced because we're going to talk about the one biggest mistake that most investors make when investing in dividend stocks. You're not going to want to miss it. It is the number one mistake that most people make, and it is costing them money. So today, as we explore the dividend world, I'm going to take you through how to find a stock that pays a dividend, how to look at whether that dividend is safe and secure, whether they're going to be able to continue to pay that out, and then the most important key, are they raising their dividends? Meaning, are the dividends getting larger and larger each year? Something that can be called dividend aristocrats, dividend kings. We'll talk about that as well. You're going to love this video. Okay, so the first big mistake that people make is they come in and they search for the highest dividend yielders. And what's the problem with that? If you're searching for the highest dividend yields, you might think, well, they're the ones that pay out the most yield. Well, that's like investing in bonds, but going and finding the junk bonds. Understand that when you invest in a quote unquote high yield or junk bond, you are investing your money or lending your money to the riskiest businesses out there. That's why they pay a high yield. Dividend yield is very much the same. The reason the dividend yield is very high is typically because the stock price is tanking, the business is under attack, and so of course the yield looks really high, but what's the problem? That company is struggling. High dividend yielders are the most likely companies to slash their dividend, to stop paying the dividend altogether, and to continue to have major problems. So searching for high dividend yield is the single largest mistake that most people make, and it is costing them big time. Instead, we want to search for companies that pay a sustainable dividend. We want to look at, now here's Coca-Cola as an example. If I come down and look at their dividend information, right now they pay $1.94 per share per year. That's 2.67%. A normal rate of dividend is probably similar to what you can get in terms of interest rates from very safe bonds and so forth. Now, if I could get a higher dividend yielder, I'm probably taking on more risk associated with that. If I look at a company like Verizon, well, Verizon will pay a higher yield than will Coca-Cola. However, if I come over to Verizon and look at it, you'll see it's paying 6.41%. Well, what's the difference? Verizon seems safe, it seems stable. Well, again, there's usually something going on, and in the case of Verizon, not that it's not safe necessarily, but they have a huge amount of debt, massive amount, $178 billion worth of debt. Their debt to equity is 182%. So when we're looking at this in terms of the dividend, they are paying out a high yield, but they're way extended as a corporation. So where you saw the 100% payout ratio for Verizon, here we have a payout ratio of 76% for Coca-Cola. Now, what does that mean? A payout ratio is basically, do they have enough earnings to pay out? Now, a dividend is dividing up the profits of the company, right? A company has the top line, which is revenue. That's all the sales they make. All the customers come in and spend money, but that's not profit. They have to pay all of the expenses, right? They have to pay employees, they have to pay for all the product, they have to rent spaces, they have to do all these things. And so those expenses get deducted from the revenue, and down at the bottom line is how much you keep. That's the total earnings. Those earnings can be divided up. Well, Coca-Cola only pays out 76% compared to Verizon, which is paying out over 100%. So what does that tell me? It tells me that Verizon is paying out more in dividends than they actually have in earnings, and that's not sustainable. You never want to see the payout ratio above 100%. That tells you that this company is really overextended. They're paying out more in earnings than what they actually have in profit, and unless the business turns around, that's just simply not sustainable long term. Coca-Cola, again, only $19 billion in debt, much more sustainable type of numbers. Now, I'm not suggesting that you have to rush out and buy Coca-Cola, but it is more sustainable. They have more profits. And then if we keep looking, let's take a company like Apple, and you're going to see some even better numbers, because if I go into the statistics for Apple and I say, well, what does it pay in dividends? Not a high yield, it's only 0.45, but look, they're only paying out less than 15% of their earnings are getting divided up, meaning that Apple has a large amount of retained earnings. They have billions of dollars worth of earnings that they're keeping, and because they're keeping that profitability, we know with such a low payout ratio, they're able to continue to increase the dividend. Notice that last year they paid 97 cents, this year they pay $1 in earnings, so it went up by 3%. That right there is probably the single most important factor when investing in dividends, is find the companies that are raising their dividend. Find the companies with low payout ratios that are raising their dividends, because those are on a very good sustainable path. If the payout ratio is above 100%, if the dividends are not being increased year over year, if the dividend yield is abnormally high and it just stands out as being a big problem, you got to dig in a little further on those companies, because the high dividend yielders, it's a junk bond type of scenario. You've got to be careful that you know what you're buying into and the type of risks involved. Now that we've explored how to invest in dividends, you've learned about the current rate, you've learned about the prior rate and that dividend growth, you've learned about dividend yield, and you've learned about payout ratio. As you continue to go down this path, you'll get more and more informed and better equipped to invest in dividends. So now that we've explored how to invest in dividend stocks, the next video you'll want to watch is right here. It is how to find a blue chip stock. If you liked this video, if you thought it was useful, click the subscribe, make sure you hit the bell to be notified of the next video, share this. We love to have you here. We love to teach. We love to explore the markets together as students of investing. Thanks for joining us. See you next time.